This is why Dave Ramsey hates life insurance, because he over leveraged himself and the bank said, we want to get repaid. And he didn't have the assets to repay it. And unfortunately, life insurance is completely misunderstood. Yes, the death benefit provides for my family. Now I have cash value guaranteed growth that I can use. And now I have permission to take risk with my investments outside of the policy. And that's what I was talking about with that client, is like to use the cash value to go buy rental properties. And there's no debt service like there is with a mortgage.
Yeah. Structured loan. What do we mean by unstructured? Meaning you can take a loan and not have to pay it. Like you said in the video, when you take a mortgage, you have to pay.
So if I go buy a sports car with the cash value and I die, my wife gets the sports car minus whatever I took out minus the interest, and then that death benefit's tax-free.
When you say that you're borrowing using the death benefit as collateral, and I don't want to put words in your mouth, but it's essentially, it's like the ability to have an unstructured loan and be able to do whatever we want is only made possible because of the death benefit.
It's so funny when you get all these negative comments about insurance and then they compare it to the S&P or 401 and all these other things. That's not what insurance is for. It's not an investment. It shouldn't be compared to an actual investment. There's different reasons to make different financial decisions. And when you realize the tools that are at your fingertips, now it helps me make a better decision. Like I literally had a meeting this morning with a real estate investor and he's like, with rising interest rates, it's not as attractive to borrow. Yeah, it is. The rate to borrow is 5 from your insurance contract, this one company, and it's not going to change for 12 months. Your HELOC doesn't do that. The bank can call the loan. The hard part with this and social media and short clips with reels is, it's hard to tell the whole story.
Hey guys, welcome back to another Better Wealth Reacts. It's not just me. I got my good friend Matt Love in this reaction as well. And we're going to be reacting to a video that Matt did on his Instagram. And Matt, it's gotten over 1 million views on your Instagram. Yeah. It went totally viral. And then this person named Edward Collins reacted to your video. I remember watching it and sending it to you, and I'm sure many people sent it over to you. Edward, does a lot of reactions to people's TikTok and clips, and he seemed to disagree with you or kind of like, have a different take. And it was fun for me to watch this because I knew exactly what you were talking about. I understand and agree with what Edward's talking about. And so what I would like to do is I would like to watch this. I would love to hear your reaction, and then I would love to have a discussion because I think this is the kind of content that I think will make us all better by having a deeper conversation about. And so without further ado, let's jump into the clip. And just so you know, like they're going to strip this. So we're going to watch it for the reaction, but it doesn't really matter because they'll take a different clip of it, put it on.
Oh, okay. Do I need to mute it?
No, you don't have to mute it. Just like we're going to pull your reaction and my reaction to what he's saying. So 3, 2, 1.
How often do you have to make a mortgage payment?
Once a month.
Once a month. Because it's a recourse loan. What happens if you stop making the mortgage payment?
They're going to come get our house.
So the collateral is your house. The bank isn't just going to give you 87 grand to go enjoy. If you stop paying it back, the bank gets the asset. You follow?
Yes.
In life insurance, my collateral is the death benefit. The company's already on the hook for millions to my wife when I die. I'm going to call the insurance company and say, I want to borrow 100 grand. I'm going to borrow against the death benefit. If I never put the money back into my policy, when I die, my wife gets the million minus the 100. She gets $900,000 tax-free.
Let's cut to the chase. When it comes to loans and life insurance, that loan is between you and the life insurance company, not between you and the cash value or the death benefit. And that life insurance company is going to collateralize that loan. But they're not collateralizing it against the death benefit. They're collateralizing it against your cash value. And here's the problem. If you do not properly structure that policy with regard to the death benefit relative to the cash value buildup and the guideline premiums, you could end up in a scenario where the loan outstanding with all of the accrued interest has exceeded the cash value build up within that policy. When that happens, that policy will lapse, and that could create a taxable event for you while leaving you without coverage. Now, don't get me wrong. I actually think life insurance is a good tool. It just has to be used.
All right. So those of you that follow the Better Wealth channel, you know that we do lots of different reactions and thoughts around life insurance. And so without further ado, Matt, welcome to the show. And I would love your initial reaction to this is like 4D reaction. You're reacting to someone reacting to your viral clip. Welcome, by the way. And what was your?
It's almost like what you would do back in 20 years ago and have a conversation rather than reactions. But this is cool too.
So what's your initial thoughts when people started sending this to you? What was your initial thoughts?
Well, at first when people started commenting and stuff, it was cool because you get positive and then you get the haters, right? The hard part with this and social media and short clips with reels is, it's hard to tell the whole story, right? You have hours. I have hours of content that teaches how insurance works. So first thought is that this is a clip of a much longer conversation that I was having with a client. And it was fun to watch it go kind of viral and all these people are reacting. I mean, all these followers came out of the woodworks, which is super cool. I mean, you do organic too. So that was fun to see. And then he's not the only one that had a reaction. You know, I also think, I don't know what the term is, but not unlike what you're doing, it's for reactions and to help people understand it. So what he's doing, his intention is very good to help people understand the details that I perhaps left out. And he's leveraging somebody else's content, not unlike what you and I do with other people anyway. So dude, am I mad about it? No, not at all. I'm glad that the clarity came out because there are things that I didn't mention, you know, unfortunately or fortunately, because it sparks this dialogue, which is really what the internet is, I think, does a better job of allowing people to learn if they can go deep enough. So I wasn't mad at it at all. It made me laugh because literally, dude, a dozen people sent me that video, and I was like, and somebody said, "You're going to get a lot of followers." I'm like, I don't think I will from that. I got a lot more from just posting the video rather than this guy's reaction. That said, this guy's stuff is really good. Like that guy has stuff coming out constantly on pretty cool topics.
Yeah. Okay.
But they're short clips, right? And the thing that I don't like is that you take somebody's content, then you swoop in as if you're the authority, the authority in that space, and people just say, "Okay, now he's the authority." Well, kinda.
Yep.
You know,
I think attention, like the person that has attention, for better or worse, authority comes with it. What is your initial thought? So
think about this.
You obviously
Really quick. Negative attention is still attention. Just ask Donald Trump.
Yeah, correct. All right, so let's talk about what you said in the video. You made it sound like, okay, you're borrowing against your death benefit. I actually know what you mean by that. And so what he's taking what you said literally and saying, no, that's not true. I have had people in the past that have heard a message, and they actually get mixed up, and they're like, oh, can I take a borrow actually against my death benefit? And we have to explain what we mean by that. So instead of me explaining, I would love for you to take like a responsive, like, what do you mean by that? Is there anything that you disagree with what Edward talked about? And or what did you mean by you borrow against your death benefit?
So not that I disagree with what he said. I think he also left out a few points if we want to go that detailed, but and I like the way that you've said this in the past in conversation with me. So in order to have cash value, I have to have a death benefit. And this conversation that I was having with the client was talking about using the cash value. And an easy way to explain a non-direct recognition loan, in other words, an easier way to express how to borrow against the life insurance contract, my cash value is going to grow forever. So when I'm borrowing money from the insurance company, not myself. And so my cash value is going to grow. If I die with the loan outstanding, the death benefit is reduced by the amount of the outstanding loan plus interest, which somebody else pointed out. But then they also ignored the dividends that are on the gross value of the cash value, ignoring the loan. So there's so many details here. This is the national test. Is your phone going crazy? Okay. Hopefully we can edit that out.
Let me just turn off my phone.
My wife's been worried about that. She's been talking about that for a month, and that's all it was. Oh,
Yeah.
Yours too?
I was supposed to turn my phone off, and I didn't. So, all right.
That's funny. And so I'm using. So if I die with the loan outstanding, the loan plus the interest is taken off the death benefit to my family. So if I go buy a sports car with the cash value and I die, my wife gets the sports car minus whatever I took out, minus the interest, and then that death benefit's tax-free. What he mentions of how you structure it properly, obviously that's what we do, right? I mean, that's the whole point of it. I'm not saying go buy term insurance and borrow against the death benefit. There has to be some level of integrity here from the listener's perspective, right? Anyone who just goes out and buys term insurance, say, I'm going to go borrow against it without actually having a conversation about that before underwriting, before application, before giving the insurance company money. That's a big mistake. So it's the type of contract that we use. The non-direct recognition, I think, is important because that's why when you talk about the death benefit's going to pay off the loan, my cash value is still growing, and so is the death benefit technically, without recognizing the loan amount. And you also can have riders in companies that you and I use, an overloan protection rider, so the policy can't lapse by taking too much money out. So that's like It's a scare tactic. Yeah, it could. And quite frankly, if it does, it could be a massive taxable event on money that you actually never realized. It could be a really big problem. And that's why insurance companies realize that, and they create a rider on the policy that doesn't allow you to take out too much, so that can't trigger a taxable event. That said, it's also not for everyone. What I think is so funny when you get all these negative comments about insurance, and then they compare it to the S&P or 401 and all these other things. That's not what insurance is for. It's not an investment. It shouldn't be compared to an actual investment. There's different reasons to make different financial decisions. And when you realize the tools that are at your fingertips, now it helps me make a better decision. And unfortunately, life insurance is completely misunderstood. It's yes, the death benefit provides for my family. Now I have cash value guaranteed growth that I can use. And now I have permission to take risk with my investments outside of the policy. And that's what I was talking about with that client, is like to use the cash value to go buy rental properties. And there's no debt service like there is with a mortgage. What, it's beautiful. So is it for everybody?
That's
No.
because you have a permanent death benefit. So the way that I explain this is life insurance is a contract between you and an insurance company. It's unilateral, meaning if you do your end of the bargain, they're on the hook from day one that contract is signed till the day that you die. Okay, so it's a contract. We want, not all contracts are created equal. You have to so that's one thing that we could dive into. Not all companies are created. Not all parties that you go into contract with or business with are created equal. So those are important.
And that's across the board, though. I mean, that's not a unique to life insurance either.
But then if you go deeper, there's only, in my understanding, there's only one real institution out there that allows you to have an unstructured loan. What do we mean by unstructured? Meaning you can take a loan and not have to pay it. Like you said in the video, when you take a mortgage, you have to pay. Even if you take a HELOC, the bank could change the rules and require you to pay that. There's certain other loan products out there that create that flexibility, but at the end of the day, their institution needs to get paid from a cash flow perspective.
There's red tape whenever there's a loan, right? The question is how much red tape.
Right. When you enter into a contract with the insurance company, their actual liability is not the cash value, it's the death benefit that they're on the hook to pay you, and it's a permanent. So it's, unless the contract is void, they're going to have to pay at some point. So the reason that they're like the only institution out there that are like, you can take out a loan and not have to repay it, because we ultimately are going to get repaid eventually, because we have this liability on our balance sheet called your death benefit that is going to get paid to your estate. And what we'll do is anything that's outstanding, any outstanding loan will just get subtracted from that. And so when you say that you're borrowing using the death benefit as collateral, and I don't want to put words in your mouth, but it's essentially, it's like the ability to have an unstructured loan and be able to do whatever we want is only made possible because of the death benefit. Of course, you're not borrowing from your death benefit. You're not, the cash value and death benefit in a way is collateralizing your ability to do that. Because if all you had is the cash value with no death benefit, you wouldn't have the same access to the cash with the same unstructured loan. So I think this is the reason I'm so excited to talk to you about this, because like we're actually talking about something that I don't think anyone on YouTube has really like discussed. And this is what gets me excited, because there's nuances to every subject, and it allows us to dive into it. What is there anything that you want to say on my little rant?
You mentioned there's only one company that has a non-recourse. You said one company. What are you talking about?
There's only one like institutions that can give unstructured loan payments. So I'm not saying one company in general, but like insurance companies. I don't know of any other institution that allows you to take loans and not have some type of payment schedule. Maybe reverse mortgages have a version of that, because it's like, so I think reverse mortgage has a version of that, but it's still not the same. It's nowhere near the
no. And that's the cool part when people talk about investing, and anybody in real estate understands the value of other people's money. Well, other people want to get repaid. If I put a death benefit in place, that insurance company owes me my family that money when I die. They don't care if I borrow it now or if I die 20 years from now. Right. So that's why they don't care to get paid. And if I'm using the cash value should also not be staying in the policy. It should be used. So if I pull it out to go buy an asset, let's say I flip a house. Well, if I use a mortgage to flip a house, I'm going to have to pay debt service for those 6 months while I'm rehabbing the house. If I use my cash value, I don't have any debt service for those 6 months. because they don't care if I repay it. When I pay the loan off, there'll be interest, but I better make a good rate of return. The only reason I would take money out is because I can get a rate of return better somewhere else that I can control. Real estate, business, your friend's t-shirt company, I don't know. But I want to be able to use that cash and not be required to repay it on their terms. Something else that's crazy because HELOCs are pretty dope. I have a HELOC. That interest rate is not the same as when I bought my property 2.5 years ago. It went from, I think it was around 4 when we started. It's like over 9% now. Okay. Insurance companies don't do that. Insurance companies change the interest rate to borrow. They can change it on a monthly basis, but for the most part, on the anniversary, that interest rate is locked in for 12 months. So it's not going up. Like I literally had a meeting this morning with a real estate investor, and he's like, with rising interest rates, it's not as attractive to borrow. Yeah, it is. The rate to borrow is 5 from your insurance contract at this one company, and it's not going to change for 12 months. Your HELOC doesn't do that.
Yeah.
The bank can call the loan. I met a guy years ago had a bunch of a big business in Michigan, and he was banking through a very well-known bank. I guess I won't say the name. And they called the loan on him, dude. It bankrupted his company. Yeah. This is why Dave Ramsey hates life insurance, because he over leveraged himself, and the bank said, we want to get repaid. And he didn't have the assets to repay it. This is why I wrote a book, Don't Be Debt Free and Broke, because solvency is better than debt free. I'd rather have the ability to pay off the loan, but you better believe I'm going to go borrow money at 4, 5, 6% because I can get a better rate of return elsewhere.
Let's talk about something else. So I think we've kind of put a bow on the whole, what you meant by this video. And I look forward to hearing your comments. And if you want to have a part 2 on a follow-up, please let us know in the comments. But let's talk about Don't Be Debt Free, or being debt free and broke. Or is that the title of your book?
It's called Don't Be Debt Free and Broke.
Okay. I'm one of these people, and it's not original Caleb thought, but it's like, I believe in a mortgage or having debt in certain aspects creates less risk. And like a lot of people just like lose, like, they're like, what do you mean? They're like, the whole idea of the American dream is to have a paid off house. I even had someone I highly respect. They said, Caleb, like there's just something about having a paid off house that's like puts everyone, like, there's that peace of mind. And I don't disagree with what this person's saying, but like actually mathematically, I would be more afraid if all my money was tied up in my house than just like put it in a side account and paying mortgage payments on it, because I just understand optionality. I understand the differences that can happen. And so all that to say, what is your thoughts on all of that?
I think you're right. I think Dave Ramsey is good for a lot of people. But when he went bankrupt, he didn't have the ability to pay off the loan. Solvency means that I have the ability to pay off the loan. And in the business world, they call it a sinking fund. So if I owe debt over here, rather than put money towards the debt, I would put money towards an investment that can get a rate of return, and I'll have more money. And it's basically, it's a sinking fund because that money is earmarked to pay off the debt, but I can do it quicker by getting a rate of return. And if I can get 12%, like Dave says, my goodness, I don't know why I would want to pay off 4% mortgage if I could do that. But I don't think that's true either, what he talks about. So when you look at risk involved, solvency is less risky than being debt free, because I have the ability to pay off the loan. I just don't want to. So that's what the book is about. And there's no mention of life insurance in the entire book. It's all just mathematics. I wrote down a couple of things. Another thing that I think is crucial to understand with good debt is the idea of inflation. I saw something the other day, since the new president took office, it's like up 22%. That means my $100,000 a year is worth 78,000 a year now. Well, if I know that my dollar is worth less 10 years from now, or 30 years from now, why wouldn't I want to lock in a rate that's guaranteed never to change at a bank, print off 360 checks, and have those checks sitting on the edge of my desk, and every month I'll take one and send it to the bank? And what's happening to the value of those checks each year? The value is going down. The dollar amount is the same on every check. But I'm paying off an appreciating asset, I hope, a house, with depreciating dollars. Banks hate that. That's why they incentivize a shorter mortgage. So if I want to hedge inflation, which has gone gnarly in the last 18 months, 2 years, good debt helps me hedge inflation. And if I can leverage good debt on an appreciating asset like a home or real estate, then I'm going to go do that, because that actually reduces the risk that I'm exposed to, rather than put all of my cash inside of a house. And then I think about this. Here's something interesting. You know, the equity in your house is not yours. I don't have equity in my house. The only way to get equity out of my house is to have a third party lender approve my income, approve my debt to income, like my credit score, and let me borrow their money to get a HELOC. That's the only way to get equity out. The only other way is to sell the asset. And as you know as well as I know, rich people sell, they pay taxes. Wealthy people don't sell. Buy, borrow, die. I don't want to sell assets because then taxes are due. So if I can leverage good debt, hedge inflation, and reduce my risk, dude, it's going to cost money to sleep inside. I'm going to use other people's money to do it.
I think you're well spoken, and that's gonna get people thinking. Just going back to inflation, the concept of inflation is our dollars literally are getting less and less valuable every year. And so if you take a mortgage payment or just cost of living, and over time, like let's say your mortgage payment is $2,500 today, and then 20 years from now that same $2,500 payment is going to feel like a lot less. What's
Feel
your
much
thoughts
less.
on buying versus renting right now? Like, do you have initial thoughts on that?
I don't know, man. I don't have much of an opinion. I was talking to my wife, like how lucky we are at the timing that we bought this. When we moved to Tennessee, we splurged and bought a big old house, and thank goodness. And then the market goes up and it's doubled in value. So we have tons of equity. Renting, you're throwing money away. I'm not against what Grant Cardone says.
Yep.
He rents his house because he can leave whenever he wants. Dude, I totally get that. I have 3 little girls. Where am I going to go?
Yep. Well, and I think it's just the cost of living. So it's like sometimes people, they get a mortgage and their cost of just paying that mortgage is much higher than what they could rent, and so you have to look at the opportunity cost. But I think if you actually look at the data, I think like a majority of people, this is sad, but their home is a staple part of their wealth, and the people that own have advantages over people that don't. But I think from an opportunity cost standpoint, you should just look at the cost of living, and if you actually invested the difference and you invested in things that you care about, that ultimately move the needle in your life, I think you can make an argument that you could rent and actually have more wealth if you were diligent with the
Totally.
difference.
Maybe if you want to go take more risks, sure. This is what's great about the financial world is I don't have to tell people what to do.
Yep.
And and what's funny, because a lot of the negative comments on videos, it's like, I'm not telling you to go do this. I'm just showing people what it would look like if you did.
Yep.
And I know that I would rather have equity in my life insurance than equity in my home. It just so happened that the market gave me a lot of equity in my home. So you better believe I'm going to go use that to go do what you're talking about. I think there's also a rate of return on happiness. And for some people, it's a house, and some people, it's a home. Talk to my wife. We have a home. We have a beautiful home. And I have no problem owning that outright rather than spending $5,000 a month in rent. No, I'm not going to do that. If I was a single dude and I didn't have a lot of needs, I'd get a 1-bedroom apartment and a ton of investments. There's a rate of return of happiness. But because I have a lot of death benefits, if something happens, my wife and family are taken care of. I have access to capital without the red tape and without the repayment rules that a HELOC and some of those other debt require. And now I have permission to go take risk with what I'm doing with my money. It's like there's a rate of return of happiness. And I think people can be so caught up with just turning $5,000 into $10,000. That's not wealth, man. It's like you got to figure out what's right for you.
Absolutely. How do your overall philosophy with life insurance, like when did the epiphany hit you that you're like, hey, this is like a very misunderstood asset that could help so many people?
For me, it's why I got into the business. So I was 27 years old, and my best friend at the time lost his mother, and she didn't make a lot of money. My friend has never met his father. So it was he and his mom growing up, and she was diagnosed with cancer in like January, and by April she was gone. So here's a woman who didn't make a lot of money, and she had $500,000 inside of a retirement account. She didn't retire. That money goes to her son, and he had a choice. Do I leave it in or do I take it out? Now you have to take it out with the new laws, but he could have left it in. And the advice from his advisor at 27 was leave the $500,000 in the account for your retirement. It's for your retirement. And I was like, well, hold on, dude, you're 27. You don't retire until you're 60. Do you think your mom would want you to spend this money? Like, did she want you to have it, or did she want the advisor to get a fee on this for the rest of your life, whether it goes up or down? Mind you, what are the odds that the advisor is going to be in the business 33 years from now when you turn 60? She's not. The advisor will be long gone. So what I realized early on is that retirement accounts are the retirement accounts for the advisor, because they get to charge fees on pre-taxed amounts with no exit strategy. And then they'll sell their book of business and then they retire. Meanwhile, I'm going to pay all the taxes on all the distribution, Medicare tax, Social Security tax, state tax, federal tax, and market volatility. And I was like, dude, at the time I was putting money into my 401k as an architect, smallest tax bracket of my life, postponing my savings or my use of my dollar till the age of 60. And I was like, I reconsidered all of that. I watched my dad help my friend, and dude, no, I'm not lying. When he used his cash, so we basically took money out of the policy, out of the IRA, paid the taxes. Some money went into the life insurance. He's used the life insurance over and over again since that happened 13 years ago. He built a 4,000 square foot home with his new wife, and now they have 2 kids. And his mom helped pay for that. Like, that chokes me up. He wouldn't have done that if he had the IRA. You don't need a retirement account to retire. You need cash flow. You need money, and where your money sits is more important than rate of return. I want to use my money.
Yeah, there's a lot of nuggets. I think life insurance is so misunderstood. Unfortunately, there's a lot of people that sell it and promote it that aren't doing the industry and our profession a favor. They're selling it as an investment. There's a lot of bad actors in this game, but if you
And you know what's funny, dude? You can make numbers work in
Yeah.
your favor if you know how to make a calculator or an
Yeah.
Excel sheet. And you see guys out there using these calculators with how you're double dipping and creating the arbitrage and a great rate of return. Look, dude, I'm not going to lie. Life insurance rate of return sucks. You're going to not get a great rate of return, but you get access, you get use, liquidity, control, death benefits, you get waiver premium. If I get disabled, my insurance company is going to pay all the premiums for me. When I retire, here's something interesting too. If I have $1 million in life insurance, I would need $3 million in a 401k to duplicate the cash flow that it can produce. So the industry wants you to take risk, and they tell you the rate of return on life insurance is so bad. Well, relative to what? There's no tax, there's no fee, there's no market volatility.
And it's also like it's impossible to measure an asset. It's a lot of people want to compare an apple versus an orange, and it's like when you
easy.
understand like the multi benefits, you have to be educated on every single benefit you're getting by having life insurance as a part of your portfolio versus not. I think when you educate people on all the benefits, it's like, oh, like the rate of return doesn't share the whole picture.
Yeah. And what I love about doing this is you don't have to apologize to a client when the market goes down. The S&P dropped 20% last year. I had clients getting 30, 40% cash on cash rate of return inside of a policy just by making a deposit into the policy. Policy went up. So you don't have to apologize. And I found it liberating. So in the beginning, the first few years, you learn how stuff works, how the policies work. You learn how to compare it to all these other things. So a lot of education went into like learning the career. But then I had a moment of clarity, probably 3 years in, a moment of liberty where my job isn't to care for this more than somebody else. My job is just to show somebody how it works. Their job is to say yes or no. Do I want this? And so if I can just get really good at helping somebody understand what their options are, now I'm hands off. I'm not even responsible for the rate of return of the asset, like an asset manager who's throwing darts on a wall saying, I think the stock market's going to go up. I don't have to do any of that. Now I can allow clients the permission to go take risk in something that they want to control, like real estate or business.
Yeah. It's good stuff, man. Is there anything else that you want to say? I appreciate you coming on and sharing your perspective. And I just love having conversations with you because you're very articulate, and it's been fun to just grow in our friendship together and just see like
we've been friends a long time. When I met you, I don't think you were shaving.
I definitely
think you
wasn't. I didn't have
you just
anything
got your
shaved.
first car. 16 years old. Yeah. Well, at least are you 20? We can get a beer now, can't we? How old are you now?
I'm older. I'm old enough to drink. Yes.
Caleb, you've done a wonderful job with your business and helping people. I love the free education that you give out. Thanks for having me on again. And yeah, man.
Yeah, I'll make sure that your contact info and the way that people can follow you is down below. And let's get you back on, and let's maybe you'll have more viral clips that we'll have to explain on here. But thank you for coming on. And I think I might just like title this borrowing against your death benefit. I think that's going to get clicks, and I think that people are going to be able to really learn through this. And it's something that to date I have not really shared or articulated well on this channel, and I think it's going to elevate our audience's IQ. And so for that, thank you.
Yeah, no worries. As you're talking, I think that's a great title because people will be like, "That's not accurate." But there's another conversation that people say, like what Dave says, is when you die, you don't get the cash value, you just get the death benefit. And comparing these conversations to mortgages and housing is really appropriate because there's a lot of similarities, and it's almost like you just do a list of like pros and cons down the whole thing. So we could do a whole other video on that. But yeah, dude, thanks for having me on. I'll be sure to use this as well.
Amazing.